There is a decision that a huge number of Canadians over the age of 60 are making right now, often on the advice of a well-meaning bank teller, and almost none of them understand what it actually sets in motion. They think it is a harmless piece of paperwork. They think it is just a convenience. They think they are being responsible and getting ahead of things before health problems or old age make banking harder. But what they are actually doing, in a lot of cases, is opening the door to a tax and legal mess that can take years to untangle and can cost their family far more than they ever imagined. And the frustrating part is that almost nobody warns them about it until it is already too late to undo cleanly. Here is the situation. You are 60, 65, maybe 75 years old. You have worked your whole life. You have savings, maybe a house, maybe some investments outside your RRSP. You start thinking about what happens if you have a stroke, if your memory starts slipping, if you end up in the hospital and cannot get to the bank yourself. So you do what feels like the obvious, sensible thing. You go into a branch. You ask to add your son or your daughter to your checking account or your savings account or sometimes even your investment account. The teller says, sure, no problem, fills out a form, and within 20 minutes, your child's name is sitting right next to yours on an account that might hold tens or hundreds of thousands of dollars. You walk out feeling like a responsible parent who has planned ahead. What you do not realize is that you may have just triggered a chain of tax consequences, attribution rules, and estate complications that the Canada Revenue Agency has very specific views on, and those views are not on your side by default. That ambiguity is exactly the kind of thing that turns into sibling disputes, estate litigation, and drawn-out legal battles that eat away at the very inheritance everyone was trying to protect. Now let's talk about the part that affects you while you are still alive and still filing tax returns, because this is where thousands of retirees are quietly making mistakes every single year without realizing it. When you add your child to an interest-bearing account or an account that holds dividend-paying investments, Canada's attribution rules come into play. These rules exist specifically to stop people from shifting income to a lower-taxed family member to reduce the household's overall tax bill. Under these rules, if you are the one who contributed the funds, any income earned on those funds is attributed back to you for tax purposes, regardless of whose name is also on the account. That means you are the one who owes tax on that interest or those dividends, even if your child's name is right there on the statement, and even if your child never touches a cent of it. This becomes a real financial problem in 2026 because interest rates, while down from their recent peak, are still sitting at levels that generate meaningful income on savings. A retiree with $250,000 sitting in a high-interest savings account or a GIC laddered at around 3.5% is generating close to $9,000 a year in interest. That income has to land somewhere on a tax return. If you assume your child is reporting it because their name is on the account, and your child assumes you are reporting it because it is your money, you end up with unreported income sitting in the CRA's data matching system just waiting to be flagged. When the CRA eventually catches that gap, and their systems are increasingly good at matching T5 slips to the correct taxpayer, you are not just looking at the original tax owed. You are looking at back taxes, arrears interest compounding daily, and in more serious cases, gross negligence penalties that can add another 50% on top of what you already owe. Let's make this concrete with a slightly different example than the classic case, because seeing the numbers land in your own bracket makes this real. Say you are 72 years old, collecting CPP and OAS, and your net income before any of this sits at $85,000 a year. You have added your son to a joint investment account holding a mix of GICs and dividend-paying blue-chip stocks worth $200,000. Between the GIC interest and the dividend income, that account generates roughly $7,000 in reportable income this year. Under the attribution rules, that $7,000 belongs on your tax return, not your son's. Suddenly your net income for OAS clawback purposes is sitting at $92,000, comfortably above the roughly $90,000 threshold for the OAS recovery tax in 2026. Every dollar above that threshold triggers a 15% clawback on your old age security payments. The statement looks the same, the shares are still there, nothing was liquidated, but the tax law does not care what it feels like. It cares what happened to legal title, and adding a joint owner can absolutely count. There are ways around triggering that deemed disposition, such as structuring the arrangement as a documented loan rather than an outright gift, or working with an advisor to set conditions that preserve your sole beneficial ownership while still giving your child practical access. But these are not do-it-yourself solutions. They require proper legal drafting, and they require you to actually think about this before you walk into the bank, not after your accountant discovers a problem the following spring. So what should you actually be doing instead if the goal is to make life easier for your family, protect your money, and reduce probate exposure without wandering into all of these traps? The starting point for almost every retiree in this situation is a properly drafted power of attorney for property. A power of attorney lets your chosen child or anyone else you trust manage your day-to-day finances, pay your bills, deal with your bank, and even make investment decisions on your behalf without ever changing who legally owns the underlying assets. Because there is no transfer of ownership, there is no attribution issue, no deemed disposition, and no gift to argue about later. From the CRA's perspective, nothing has changed at all because nothing has. You can set up a power of attorney that only activates if you lose capacity, or a general one that works immediately, and an estate lawyer in your province can help you decide which structure actually fits your situation. Of course, a power of attorney only covers you while you're alive. It says nothing about what happens to your money the moment you pass away, and avoiding probate delays is often the real reason people reach for a joint account in the first place. For registered accounts like your RRSP, your RRIF, and your TFSA, the far cleaner solution is simply naming a direct beneficiary. That designation lets those funds flow straight to the person you choose the moment you pass, completely bypassing your estate and probate, with none of the resulting trust ambiguity that plagues joint bank accounts. For non-registered accounts, some provinces and institutions allow similar beneficiary designations, though this varies quite a bit, so it is worth asking your bank directly, rather than assuming it works the same way everywhere. For larger or more complex estates, tools like an alter ego trust or a joint partner trust, set up properly with a lawyer, can achieve many of the same probate avoidance goals as a joint account while giving you far more control and far less ambiguity about who owns what and why. If you are listening to this and realizing that you already added a child to one of your accounts years ago without thinking any of this through, take a breath, because this is very often fixable. Start by finding out exactly how the account is structured. Call your bank and ask directly whether it is joint with right of survivorship or simply a convenience arrangement, because the two are treated very differently. Look back at whether any interest or dividend income from that account has actually been reported properly on your tax return, and if you are not sure, sit down with an accountant who can review your past filings and determine whether an amendment is needed before the CRA finds the gap on their own. Then talk to an estate lawyer about whether the current setup genuinely reflects what you want to happen to that money, and whether restructuring it around a power of attorney and clear beneficiary designations would serve your family better going forward. In many cases, this does not require unwinding a disaster. It requires a conversation, some documentation, and a plan that actually matches your intentions instead of leaving them to guesswork. One last wrinkle worth knowing about heading into 2026 involves means-tested benefits like the Guaranteed Income Supplement. If you or your spouse rely on GIS or any other benefit calculated from your net income, attributed income from a joint account you never expected to affect your taxes can quietly push your reported income up enough to shrink or eliminate benefits you were counting on for your monthly budget. This is the piece that catches lower and middle income retirees off guard the most, because they assume GIS is separate from all of this joint account discussion, when in reality it is calculated from the exact same net income figure that attribution rules just inflated. The bigger lesson underneath all of this is that retirement planning is never just about how much you have saved. It is about understanding how every decision, even something as small as adding a name to a bank account, ripples outward into your taxes, your government benefits, your estate, and your relationships with the people you love most. The retirees who come through this stage of life without unnecessary stress are almost always the ones who ask a professional before they act, not after a problem has already taken root. An accountant, an estate lawyer, or a fee-based financial planner who can see your entire financial picture is worth far more than the convenience of a 5-minute form at the bank counter. If this video opened your eyes to something in your own finances that you need to take a closer look at, that is exactly the point of putting this information out there. If you found it useful, take a second to like the video, because it genuinely helps this channel reach more Canadians before they make a costly mistake instead of after. Subscribe if you have not already, because every week we dig into retirement planning, tax strategy, and estate planning topics that are specific to the Canadian system, not generic advice pulled from somewhere else. I would love to hear from you in the comments. Have you already added a child to one of your accounts? Are you thinking about it? Or have you already worked through this with a lawyer or accountant and learned something worth sharing? Drop it in the comments below, because your experience might be exactly what another viewer needs to read today. Check the link in the description for more resources on estate planning and tax-efficient retirement strategies that go even deeper than what we covered here. Until next time, take care of yourself, take care of your family, and I will see you in the next one.